Hi, good morning, everyone. Thanks for joining the Phillip Research Morning Call. Today we have a few stock counter updates like Apple and Centurion, SIA Engineering initiation, and some results like Geo Energy, Thomson Medical, and the Euro SG Weekly. And there's also Banking Monthly and Semiconductor monthly. Zane is on leave today, so there will be no technical analysis today. Yeah, so without further ado, I'll hand over to Fahmi for US Software Quarterly. Fahmi, please.
Hi, hi everyone. Thank you, Meow. So, we are resuming our quarterly coverage on our US software companies, which is SaaS for short, which is the companies that deliver product in the form of software. For example, of the companies are Microsoft, Adobe, and Zoom. So, this is the updates for the second quarter of 2025. So, for the recent quarter, software revenue growth accelerated to 16% year over year, which was up from 13% year over year in the same quarter last year. So if we look at the table on the left side, the gains were led by Microsoft, which grew about 18% year over year. Also at the same time contribute to the larger portions of the software category, which was at 11 percentage points of that 16 percentage point of growth last quarter to the sector's overall performance. This also helps to offset the slower growth in the customer relationship management category. So we split the SaaS companies into four categories, which are productivity, CRM, which is customer relationship management, enterprise resource planning, and lastly, the cybersecurity. So let's take a look at the first category, which is the productivity. For productivity category, which are companies that offer software to help companies on their daily productivity routine at work, including Microsoft, Adobe, and Zoom. First is Microsoft. Microsoft growth makes up about 70% of the software sector growth. So it's kind of like safe to say that performance of the software category is very dependent on the Microsoft category. If the Microsoft performs well, then the sector as a whole means that it performed well. So Microsoft reported 18% year-over-year revenue growth to 76.4 billion in the fourth quarter. It was led by its cloud services business, Azure, that accelerated by 39% year-over-year and surpassed the prior guidance of the 34%. The growth driven by increasing need of the renting of supercomputer offerings. And for the guidance for the first quarter 2026, Microsoft expects 15% total revenue growth, mainly again to be driven by the 37% year-over-year increase in the Azure revenue, which was also up from 33% in the first quarter 2025. So the story about Microsoft is mostly focused on the story about their AI capacity, whether they could provide, and the needs of increasing demand for their AI capacity. So despite adding more data centers in the recent quarter, management still guided that the capacity constraint are expected to persist through the first half of 2026. So capex for the first quarter is forecasted to exceed 30 billion, which was up from 20 billion in the first quarter. And we expect the spending is front-loaded in the first half of 2026. In there, the use is to expand the capacity and address the 368 billion in the contracted backlog, primarily from cloud and AI demand. So next we have the next company, which is Adobe. Adobe revenue increased by 11% year-over-year to 6 billion in the third quarter of 2025, and driven by the strong performance in its subscription business. Subscription revenue from the creative and marketing professionals, which are the larger segment of the Adobe's revenue, rose about 11% year-over-year to 4.1 billion US dollar, and this is supported by the growing demand for AI-powered features across their flagship applications such as Photoshop, Premiere Pro, and Illustrator, which so there's also guided that the new subscription to the Firefly app, which is Adobe's AI integrated applications, by individuals and by the enterprise are also seeing strong adoption. And for the guidance for the financial year of 2025, Adobe raised its revenue and earning per share outlook, citing strong annual recurring revenue growth across all the geographies and market channels. Lastly, we have Zoom, who only contributes small portion of the productivity category. Zoom's revenue rose about 5% year-over-year to 1.2 billion. Growth driver for Zoom was mainly on two things that contribute to the majority portion of the revenue. First is that the enterprise customers grew about 7% year-over-year, and the customers who contribute to the large revenue portion, which is, for example, larger than 100,000, grew about 9% year-over-year. And for the guidance, revenue is expected to grow 2.1% in the third quarter of 2026, with a continued strength in the enterprise business and Zoom Workplace. Next one, the next category is the CRM, Customer Relationship Management. CRM is a company that offers software to manage a company's interaction with the customers and help providing sales. Salesforce, first company is Salesforce, revenue grew about 10% year-over-year to 10.2 billion in the second quarter of 2026, and driven by 11% growth in the subscription and support revenue. Salesforce benefited from the average revenue per user growth due to its existing customers shifting to more premium product and adopting multi-clouds. So some highlight on the recent result for the Salesforce is that the operating margins continue to expand for the 10th straight quarter, up to 23% in margin. And they also reported to cut about 4,000 support staff, which is 5% of its global workforce. That they are focusing more, using more AI to replace this worker. So, and the next for the guidance, Salesforce project total revenue to grow about 8% year-over-year, to be fueled by strong momentum in data cloud and contribution from Agentforce, which is their AI applications. So next one is HubSpot. The revenue is expected to grow 18% year-over-year, to be led by increase in subscription revenue by 19% year-over-year. Main metric is that the total customers globally grows about 18% year-over-year to 268,000, while the average subscription revenue per customer remained flat year-over-year. The pattern is that for this company, the new and the existing customers are more and more consolidate their marketing materials on a HubSpot instead of using multiple marketing appliances. In effect, it helps them to cut costs, unify the customer data, and accelerate the AI adoption. And for the guidance, which is for third quarter 2025, revenue is expected to grow 16% year-over-year, as HubSpot looks to capitalize on the rise of AI-driven marketing search and the global decline in the organic search traffic. Next is for, next slide, please. All right, thank you. Next is for the ERP segment, which is enterprise resource planning, which is for the companies that provide systems that manage and integrate core business process for different departments like finance and HR. So two companies are Oracle and SAP. Recently, Oracle posted about 14.9 billion in revenue for the first quarter of 2026, which was up 12% year-over-year, mainly driven by the cloud revenue business, which was up 28% to 7.2 billion, and that makes up the larger portion of their total revenue, which is about 48%. For their ERP products, which is Fusion Cloud ERP and NetSuite Cloud ERP, both of them grew strongly at 17% year-over-year and 16% year-over-year respectively, both reaching the $1 billion. But in particular, the main growth driver for Oracle is actually on the cloud infrastructure, which delivered the strongest growth, which rising about 55% year-over-year to 2.3 billion, which was last year, it was about 45% year-over-year. So it was fueled by the increasing demand for renting computer power and storage services. And recently, in the recent earnings quarter, Oracle's remaining performance obligations surged by 359% year-over-year to 455 billion. And they reported that this is driven by 4 multi-billion-dollar contracts signed in the previous quarter. And the companies also expect the RPO to exceed by 500 billion in the coming months, and has revised its cloud infrastructure revenue, which is their fastest growing segment, forecast by upward 77% to 18 billion for the financial year of 2026. For SAP, the next ERP companies, the total revenue grew about 9% year-over-year in the second quarter, and this is again driven by the continued momentum in its cloud business, and which rose about 28% year-over-year to 5 billion. The growth was primarily fueled by strong demand for its cloud ERP suite, which surged about 34% year-over-year. So SAP saw strong customer adoption and expansion, especially in the Asia Pacific and Japan, which grew about 33% year-over-year in cloud revenue, compared to the rest of the other regions, which was only growing at double-digit but still low double-digit. For the guidance, SAP reaffirmed its financial year 2025 cloud revenue guidance, and which reflect about 27% year-over-year growth. Lastly, for the cybersecurity, we are seeing a trend where there is an increasing need of cybersecurity, especially for companies that are adopting artificial intelligence, that's including Gen AI and Agentic AI. Management guided that generative AI traffic surged over 890% in the 2024 compared to 2024, with data security incidents related to the Gen AI more than double year-over-year. And growth drivers for these particular categories is at first driver is the increasing volume of larger deals secured. For example, CrowdStrike number of 10 million deals double year-over-year, and the company reached a milestone of 800 customers with annual recurring revenue exceeding $1 million. Next is Palo Alto, on the other hand, also added 490 million in net new next-gen security annual recurring revenue during the quarter, supported by the firm customers' commitment, including multiple large deals ranging from 33 million to 100 million. Second growth driver is that the customers is adopting more than one module for the securities. For instance, CrowdStrike recorded high module adoption rates with 48%, 33%, 23% of customers using 6, 7, and even 8 of more modules respectively for the security. So revenue growth was strong for both companies and guided strong quarters ahead. CrowdStrike reported second quarter revenue growth of 21% year-over-year to 1.17 billion. And they also guided for at least 40% year-over-year growth in net new ARR in the second half of FY26, bringing expected ending ARR growth for FY26 to over 22%. And next, the last company is Palo Alto Networks. Revenue rose about 16% year-over-year in fourth quarter. And this is driven by the continued momentum in next-gen security offerings, with the NGS annual recurring revenue was up about 32% year-over-year to 5.6 million. So next-gen security refer to Palo Alto's advanced firewall and cybersecurity platform that goes beyond traditional firewall, use AI, machine learning, and cloud integration to protect networks from modern threats. And they guided that Palo Alto expect this NGS annual recurring revenue to grow about 29% year-over-year to 5 billion. And this is underpinned by robust demand for advanced security solution and the ongoing shift toward platformization, which encourage customers to buy bundle offerings instead of standalone products. I guess that is all for me. I'll pass over to Helena for Apple presentation. Thank you.
Thank you, Fahmi. So moving on to Apple. So last week, Apple hosted its out-dropping launch event. So where it basically launched its new iPhone 17 lineup. So this is just a note that we released, just mainly on the update of the event and how we think of Apple from here. So I've actually summarized the new upgrade features. It's a little bit detailed, a little bit technical, so I'm not going to go into the details. But basically, what's new, what's the spotlight is for the iPhone 17 lineup. They actually introduced a new something called iPhone Air. So it's the first iPhone Air in history. It's ultra thin design. It's only 5.6 millimeter, which is a lot thinner than the normal iPhone now. So just to give you a comparison, the iPhone 16 right now is 7.8 millimeter, and the 16 Pro is 8.3 millimeter. And you know, the word Air came out, you would think of it as like a simplified version of the iPhone 17, but that is not exactly the case. It's actually more on the premium side because take a look at the chip that they're using. So iPhone 17 is actually using the A19 chip, while for 17 Pro, Pro Max, and for 17 Air, they're all using the A19 Pro chip. So actually, iPhone Air is considered more on the premium side. So there are other features, including they have better display, and they came up with a ceramic shield too. So they're making the outside of the iPhone 3 times more resistant compared to the previous ones. Then the major update comes in iPhone 16 Pro and Pro Max, where they actually have triple 48 MP camera system. They also have a new telephoto, which is the 8 times zoom. So you can zoom in a lot closer compared to your previous iPhone. But that is not something new compared to Huawei. They've already came out zoom that's way bigger than this. And another feature that they have is the Pro Video features. So now you can really use iPhone for professional for video shooting because there's a lot of professional setups that you can do. It's also because the iPhone the exterior of the iPhone is now more resistant, so you can actually take your video in very harsh environment. So that's pretty much the summary of the iPhone 17 lineup. Next slide, please. They've also come up with some other updates and features for the Apple Watch and for the AirPod. So for the Apple Watch, basically they have more health related, like hypertension detection, which is related to detecting high blood pressure. They also have like more features for sleeping, the sleeping apnea detection, and the sleeping scoring. And it's also more scratch resistant, and they've tried to improve the battery life for all their different series. Moving on to AirPod, they're now claiming to be the world's best active noise cancellation earphone. They're now coming up with different sizes because previously they were complaining that it's not one size fit all. So some ears they feel like it's not a good fit. So now they have 5 different sizes for a better fit. They also have new features like heart rate sensor. One thing that we think might be useful would be the live translation. But that one it hasn't really been tested out in real life, so we don't really know how that's going to catch on. Yeah, so that's pretty much it. I guess next slide, please. So the main focus of the event is still the price point of the new lineup. So I actually make a summary of the past few years because every year they come up with a new line of iPhone. So what is actually the price point? So this price point is purely taken from the official website in the US website. So take a look. The number that people most care about is obviously the entry price. So what is the minimum amount of money that I need to pay in order to get my hands on a new iPhone 17? So the entry price remains $799 for iPhone 17, the lowest storage. It's consistent with the prior generation. It's always $799. But the key shift is now the base iPhone 17 now starts at 256 GB instead of 128 GB. So in a sense, that's quite a leap. That means for the same amount of price, you get a new iPhone with all the updated features, and also you get double the storage as before. And notably, iPhone has eliminated the 128 GB option across the lineup. So there's no more 128 GB. The lowest would be 256. So that kind of makes iPhone 16 Pro appear to be more expensive. Because if you take a look now, the entry price of only an iPhone 17 Pro is $999, which is slightly more expensive than only a 16 Pro. But if you really compare, you realize because 16 Pro, they have a 128 GB. So if you really compare Apple to Apple, if you compare the 256 GB 16 Pro to 17 Pro, actually the price remain unchanged. So that's why on some of the news titles, you see people saying that the iPhone price went up. So that is what they're saying because the iPhone 17 Pro entry price went up. But if you really compare Apple to Apple, their price actually remain unchanged or slightly lower, depends on the model that you see. At the top end, Apple has extended the premium tier with the iPhone 16 Pro Max, now offering a 2 TB configuration. So that's setting a new all-time high as the most expensive iPhone. And meanwhile, like I mentioned before, the newly introduced iPhone Air, it's slotted above the standard iPhone 17. You can tell from the price. It's pricing on the more on the premium side, like I mentioned just now, because they're actually using the more premium chip for iPhone 17 Air. So overall, we think, yes, they do introduce several hardware enhancement, but most of which is still incremental rather than disruptive. We continue to see very limited evidence of a strong update cycle coming up, notably because Apple, they still lag their peers in terms of AI. Their Siri update, which is supposed to be a big thing, is now postponed to 2026. The iPhone Air is undoubtedly the spotlight of the launch event, but looking at its premium price point and how they try to position it, we think it might not necessarily grow Apple's addressable market, but instead try to divert some of the demand away from the iPhone 17 Pro and Pro Max. So overall, if we look at the pricing, because the pricing remain unchanged compared to iPhone 16 and even slightly lower, so that kind of implies that Apple is definitely absorbing the tariff relief pressures and the higher production costs. So this would likely weigh further on their profitability, and their gross margin already narrowed 140 bps year on year in the last quarter. So our valuation overall remain unchanged. Our DCF target price remain unchanged at $200. We downgrade our recommendation from neutral to reduced due to the recent share price rally. We continue to maintain a cautious outlook on Apple due to the near-term headwinds from tariff, their elevated capex, and no significant AI innovation to help with their persistent weakness in products and the China market. So that's all from me. I'll pass my time to Ibet.
Thanks, Helena. Now I'll present on semiconductor second quarter update. Yep. So for overall semiconductor, we mainly try to track 12 of these companies as seen in the table on top. So if we add up the 12 companies' revenue, you will see the revenue in the blue color bars in the chart in the bottom right hand corner. So that is the total revenue. And as you can see for the second quarter itself, even though it is a record revenue of 190 billion, it is the fourth consecutive quarter of decelerating growth since second quarter last year, as can be seen by the red color line. That one is the year-on-year change. So even though the revenue increased 27% year-on-year, it is down from the revenue increase peak of 47% year-on-year last year. Yeah. However, we still see strong demand from hyperscalers because their capex, their trailing 12 months capex increased 65% year-on-year. This is the highest since 2018. And also, based on the hyperscalers earnings call itself, they are more optimistic in increasing their capex for advanced chips. For example, Meta and Google, they increased their capex guidance by 13% and 10% respectively since the start of the year. Yeah, so compared to the start of the year, they actually increased by this amount. As for Microsoft and Amazon, they are more optimistic in their capex guidance, as can be seen in the bottom left-hand corner. Yeah, so this is the summary of the hyperscaler sentiments towards their capex, and we think that second half itself, it will present a sequential growth in terms of capex, and this will flow through to companies like NVIDIA, AMD's GPU chips, as well as Broadcom's networking equipment, as well as Micron's memory chips itself. Yeah, next slide. Yeah, so going down to the individual categories for processor-wise, revenue increased 44% year-on-year. So this is the fifth consecutive quarter of decelerating growth as well, as mentioned earlier. So this is also due to the exceptional growth in 2024. And we still see strong demand for AMD, NVIDIA, and Broadcom's AI GPU, CPU, and networking products. For NVIDIA itself, for next quarter, we do see a potential $3.5 billion of H20 chip sales to China. And this may increase their third quarter revenue by 64% year-on-year. Previously, they guided 54% year-on-year. Yeah, we do think that this H20 chip sales, there may be potential sales to China because in terms of their H20 inventory, it is ready to be sold to China already. So they have received some licenses, and they mentioned that potentially $2 to $5 billion, which is midpoint $3.5 billion of H20 can be sold to China. This is unlike AMD, because AMD, their H20 inventory is still work in progress. So they are not expecting any China chips sales to come in their third quarter revenue. For Intel-wise, They are still undergoing the restructuring procedures. In second quarter itself, they completed their layoffs to achieve a 75K employee target, and this reduced their management layers by 50%. And in second quarter itself, their PATMI is greatly hit, is down 81% year on year. However, I think for the third quarter itself, the drop in PATMI will be softer because they have reduced their manpower costs. Yeah, so going forward, I think in the short term they may see some slight improvements in profit. But I think long term wise, Intel is still losing market share to AMD, so we are still not very positive on Intel. For memory wise, overall revenue increased 14% year on year. It is the fourth consecutive quarter of decelerating growth, similar to processor. All three companies reported that HBM demand is still strong. Yeah, so Micron, Samsung, and SK Hynix. For Micron itself, they announced in this quarter that their HBM chips are being designed into AMD's Instinct MI355 GPU chips. So this is very positive for Micron because apart from AMD's GPU chips, their HBM chips are Micron's HBM chips are also being designed into NVIDIA's Blackwell GPU chips itself. So both AMD and NVIDIA's GPU chips are still ramping. So we do see the continuous ramp in the next 2 quarters ahead. And we do think that this will greatly benefit Micron as well. For Samsung wise, their revenue declined for the first time since third quarter 2023 because of a one-off impact from export restrictions to China. We do believe that their memory chips are being designed into NVIDIA's H20 chips. And because of the US government chip ban to China, Samsung also took a hit. Yep. Yeah, so as you can see in the chart in the bottom right-hand corner, hyperscalers CapEx is still estimated to increase by 31% CAGR for the next 2 years, even though we do expect a slowdown in terms of CapEx growth, but overall we do think that the CapEx will still increase, and this is still positive for the advanced AI chip companies as mentioned earlier. Yeah, so next slide please. For equipment wise, we do see an earlier than expected deceleration of revenue growth. Previously, we are quite positive that their revenue will grow. Because for example, in the second quarter revenue itself, it increased 18% year on year. It is the highest since first quarter 2023. However, for the next quarter wise, all three equipment makers, they guided their next quarter's revenue growth to slow down because of customer orders slowdown and volatility. And we do believe this is because of TSMC's expected slowdown in CapEx. As you can see in the chart in the bottom right-hand corner, the light blue color line shows TSMC's CapEx trend, whereas the red color line shows the equipment makers' consolidated revenue year-on-year growth. So it is quite correlated because TSMC's CapEx will be spent on buying equipment, semiconductor equipment. Yeah, so for example, for the next 2 quarters wise, third quarter and fourth quarter, we do see a slowdown, even though there will still be record amount of CapEx, which TSMC maintained at 40 billion for 2025 itself. For ASML wise, they experienced an increase in EUV sales. Now EUV make up a larger proportion of their net system sales at 48%. Compared to last year, it was at 31%. Yeah, so we do think that EUV provides a lot of value for TSMC itself in terms of chip making, because the EUV lithography machine is able to scale the chips to smaller size, for example 2nm and 3nm, and it is a single step process compared to the more complex DUV process itself. So this lowers the cost and also allows foundry to achieve better yields when producing the chips itself. For Applied Material, they guided their next quarter's revenue to decrease because of non-linear demand from leading-edge customers, which also we think is TSMC. Next up for foundry-wise, TSMC experienced a strong growth momentum of 44%, driven by 3nm and 5nm chips. This increase in revenue is the largest since first quarter 2020. And as you can see, the combined 5nm and 3nm chip revenue made up a larger proportion of TSMC's revenue at 60%. Compared to last year, it was at 50%. And this higher demand for advanced AI chip is also evident in the higher amount of hyperscalers capex, as mentioned earlier. However, TSMC did not guide capex for 2026 itself. We do think that there's more uncertainty surrounding tariffs because ASML did mention that their their conversations with their customers show that they are more cautious in this heightened tariff environment as compared to 3 months ago. And we do think that their customer is mainly TSMC. Yeah. So that may be why TSMC did not guide capex for next year itself. Yeah. Next slide, please. Yeah. So this is the overall view of the valuations, share price performance for the companies. For Broadcom wise, recently there has been a spike in Broadcom share price because in their third quarter earnings itself, they mentioned that they have onboarded their fourth custom AI accelerator customer. We do believe that this is OpenAI. So we do think that Broadcom is collaborating with OpenAI to create custom AI chips to run OpenAI's LLM models itself. So this is very positive for Broadcom itself, and hence that explains the recent share price movements. And this is also why Broadcom's valuations is also on the more expensive side as compared to the other processor companies. Yep. Next slide. Yeah, I'll also be touching on Centurion's update. Recently, they mentioned they submitted the preliminary prospectus to MAS. So some of the key highlights from last week itself, CCL shareholders. So just a context, CCL over here we refer to Centurion Corporation Limited. So this is the parent group itself, and then SENREIT. When we use SENREIT, we'll talk about the Centurion Accommodation REIT, which will spin off itself. Yeah, so the key highlights, firstly, CCL shareholders voted in favor of SENREIT's divestment. And the REIT will acquire the 732-bed episode PBSA in Australia only after the listing date. And after the spin-off itself, Centurion mentioned they will give out dividend in specie in the form of, for example, REIT units itself. And we do expect CCL shareholders to yield about 7.5% in this payout itself. And in the prospectus itself, SENREIT mentioned they will offer 262 million for subscription, each priced at 88 cents. And in total, there will be 1,719 units. So this values the REIT to be about $1.5 billion. And the REIT has projected DPU yields of 7.47% to 8.11% for the next 2 years itself. Our outlook for the REIT itself is that we do think that the major construction projects such as Terminal 5 community hospitals and IR construction projects will be able to support the worker dormitory demand for the REIT itself. Hence, we do think that the REIT can achieve this projected yield of 7.47% to 8.11%. And our outlook for CCL, the parent company, is that there are continuous about 37.5% stake in Centurion in the REIT post dividend in specie distribution should be able to support the FY 25 to 27 adjusted PATMI. So as you can see in the chart, the bottom table itself, this is just an illustration of how the revenue and PATMI will be like. So the spin-off is targeted to occur from 1st October onwards. So this will impact fourth quarter financials for CCL. And CCL revenue is expected to dip for FY 26 and 27 because their assets are being spun off into the REIT itself. However, because they continuously hold a 37.5% stake, so in terms of adjusted PATMI itself, the REIT will still contribute to the bottom line of CCL itself. And we do think that this 37.5% stake will continue to support these adjusted PATMI levels. And because they have spun off this Centurion REIT, they are able to achieve a stronger balance sheet. From this spin-off itself, they are expected to receive a net proceeds of $473 million. And this is expected to reduce their net debt by 89% to just about $62 million. compared to first half, it was 535 million. So we do think that this stronger balance sheet is able to position CCL better to pursue new growth opportunities. And we do think that because of CCL's very good track record of spotting good growth opportunities very early on, for example, in terms of the UK PBSA and in terms of the Australia PBSA, this stronger balance sheet will be able to give them will be able to position them better in terms of spotting the next growth opportunity itself. So our call for Centurion is that we maintain accumulate. We didn't change our target price of 2.01 before dividend in specie distribution. And we lower our FY 2025 revenue and PATMI because of the fourth quarter earlier than expected divestment date. And we also value episode PBSA at 20% discount to RNAV. So the table shows our SOTP valuations. Yeah. Next slide. I think I'll hand over the time now to Ben. Thanks.
Yeah, thanks. Excuse me. Yeah, thanks, Iqban. Yeah, so for the banking monthly, we'll start off again, firstly, with the interest rates. Singapore interest rates have continued to fall, falling by 21 basis points month on month to 1.71% in August. And this is the lowest that we have seen seen the Singapore interest rates in more than 3 years. Furthermore, for year on year, it also fell by 189 basis points in August, and this is the most significant decline, at least year on year decline we have seen in 17 years. While the Singapore interest rates, have sort of diverged from the direction of the US interest rates, right? Usually they are quite closely packed. If you see in this chart here, the red and the orange line, before 2024, it was actually quite closely packed, but now it has sort of diverged slightly. And we still expect that the SORA will decline, but maybe by not that much of a magnitude as compared to previously. The relation will be slightly smaller as more Fed rate cuts are expected. So with the next Fed rate cut coming in, we could see the interest rates in Singapore decline even more. For the Hong Kong interest rates, it has continued to recover in August. It rose by 50 basis points month on month to 2.3%, and this is a continuation of the recovery of 13 basis points the previous month. Year on year, it still has fallen by around 201 basis points, and we believe that this decline, this very, very sharp decline in HIBOR was due to a surge in capital inflows, and more investors returned to the IPO market. They also converted large amounts of USD to Hong Kong dollars, and then this boosted the supply of Hong Kong dollar in the banking system and then reduced the need for banks to offer high deposit rates to attract funds, and hence the interest rates will decline. So it's a bit of a snowball effect. Now moving on to the next slide, we'll be looking at the loans growth. So a positive from the interest rates decline would be that loans growth is usually inversely related. So loans growth will improve if interest rates decline, and we are also seeing that. So in July, we saw loans increase in Singapore at least, rise by 6.4%. And this is an improvement again from the previous month's gain of 6%, and also marks the highest loans growth in more than 3 years. Year to date is still around the mid-single digit figure at 5.4%. And we also expect this mid-single digit loans growth to hold for the full year of 2025, which will be driven by the further recovery from additional rate cuts anticipated for the rest of the year. But then again, a caveat that the trade war might end up, and the whole geopolitical environment might hamper this growth slightly. The banks are still guiding for around low to mid-single digit loans growth for 2025. Business loans rose by 6.8% in July, mainly benefiting from the surge in manufacturing loans. For the consumer loans, it rose by 6%, and this is the 19th consecutive year-on-year increase, with housing loans up by 5%. Now moving on to the next slide, we're looking at the deposits and balances. So the deposit balances was up by 8% year-on-year in July, and the current account or savings accounts proportion, or CASA, in short, the proportion was quite flat. It was maintained at around 19.1% of total deposits, but it grew by 13% year-on-year to 384 billion. So we expect that this CASA ratio will continue to rise as the higher interest fixed deposits mature and funds are shifted back to CASA. And on top of that, also a lot of deposits are being attracted into Singapore, as they exit the US market, the USD. So they're going into Singapore, and this will flow almost directly into the deposits or current account and savings account. And this is why is this beneficial for the banks is because deposits and CASA represents the lowest cost of funds for the banks. So basically, when your CASA and deposits rise, it means that your cost of funds will lower, and then this will help to improve the net interest margins and net interest income for the banks. Moving on to the next slide, we'll be looking at the SGX statistics. So it's quite another positive month again for the volumes. In August, the SDAV rose by 17%, while the DDAV also rose similarly by 17%. This growth was mainly due to the global institutions stepping into their China access derivatives offering to manage their risk across multiple asset classes, while the Singapore stock market continued its positive trajectory. The VIX, which is what we use to measure the volatility, it averaged around 15.8 in August, so slightly lower than the previous month's 16.4. And we believe that the volatility could remain heightened and it could persist for the rest of the year, particularly with the ongoing trade war and the geopolitical environment. And this will benefit both the SDAV as well as the DDAV. And also, the 5 billion EQDP could also help to further boost volumes, especially in Singapore. As for the top 4 equity index futures turnover, it rose by 26% year-on-year, mainly due to a surge in the FTSE China A50 index futures volumes. So all these improving volumes would greatly benefit SGX. Will depend a lot on volumes, and as they make a fee from each of the. If volumes go up, it means that their revenue and net income will increase as well. Okay, now moving on to the next slide, we'll be looking at the Singapore Bank's performance. Share price of the 3 local banks were essentially flat in August with an increase of less than 1%. It really came from all this improvement really came only from DBS, who was up 6%, and it was offset by declines in both OCBC as well as UOB. Why DBS outperformed the other two peers was mainly due to their clearer dividend policy as well as their guidance that they gave for further increases in FY26, and also its ability to attract more deposits. So when I said earlier about the current account, savings accounts, and deposits rising, most of that flowed into DBS because the reason that they gave and why we guess so is also because they're the largest bank in Singapore. So a lot of the foreign investors that come in, they would rather put their money in I guess the biggest local bank in Singapore, which is DBS, and hence they have benefited from this greatly. However, in overall, we expect that the bank's performance will remain quite stable for the rest of the year, as earnings are expected to decline from the net interest margin compression as well as the net interest decline, but that the capital return initiatives that all 3 banks have committed to and have continued to commit to will support the share price. Yeah. On to my last slide. Just to conclude, we do maintain neutral on the Singapore banking sector, and with the continued decline in both the Singapore as well as the Hong Kong interest rates, the bank's net interest margins have also seen a similar decrease, affecting both their net interest income as well as their earnings. But the rate cuts will help to benefit their funding costs in terms of the deposits and CASA rising in the second half of the year and help to ease somewhat the net interest margin compression. But net, we believe that earnings will still decline slightly in FY25 from the lower net interest income. Their dividend yield of still hovering around 6% remains attractive as the capital return initiatives are expected to continue for the rest of the year, and the share buybacks will also improve ROE and EPS. And last but not least, as I mentioned earlier, DBS is our pick among the 3 banks, mainly for its fixed dividend policy and ability to garner more deposits, and hence it will improve their net interest margins. So that's all I have for the banking sector. I'll now hand it over to Miao. Thanks.
Thanks, Glenn. Yeah, so we initiated SIA Engineering. Yeah, so just a quick background on the company. They operate as a global MRO facility operator in Singapore and serving over 80 international carriers and aerospace manufacturer with a worldwide network of 25 subsidiaries and also 9 GVs. And they are a subsidiary of Singapore Airline Limited. They own 77.8% of SIA Engineering. And for investment highlights, firstly, is rising MRO demand due to aging fleet and also supply delay. So Boeing and Airbus continue to face supply challenges, and they are guiding 2025 deliveries to be 28 and 5% below pre-COVID levels. And therefore, at the current rate, the backlog would take 14 years to clear, which is doubling the historical average. Thus, we expect MRO demand to continue remain robust into FY26 and even beyond. With around 80% market share in Singapore and also its JV, such as Rolls-Royce, giving a combined 30% market share of the engine MRO market, we believe SIE is well positioned to capture the rising demand. Therefore, we forecast FY26 revenue will grow 11% year-on-year to 1.41 billion. Yeah, so on the right is the revenue breakdown. So majority of the revenue is generating from the airframe and line maintenance segment. Yeah, and the right corner is the revenue projection. We believe it's going to be grow at around 18% cargo, 19.8% CAGR. Yeah. And for the next investment highlights, JV income will continue to support its capacity expansion, and SIE is expanding capacity from its new base maintenance hangars in Subang, Malaysia. So phase one is expected to complete by second half 25, and phase two will be in operation in around first half 26. And there's also a new line maintenance JV in Cambodia, which will commence operation in second half 25. We also foresee a stronger JV contribution led by the expansion of SASO, which they have 50% ownership, and also Eagle Service. They account for 49% of the ownership. And two of the JV is contributing to around 50% of the total PATMI at the group level last year. And SISL, they do have an ongoing project which will raise the engine shop capacity by 40%. And Eagle will continue to ramp up its capacity by squeezing additional capacity through space optimization. Therefore, we foresee JV income to increase by 22% year-on-year in FY26. Therefore, we'll drive PATMI to grow by 18% year-on-year. And last but not least, we believe even though there's like a temporal margin overhang, but eventually will recover from second half onwards. Since the startup and gestation costs from the expansion is waiting on first quarter 25 margin, which they did generate 1.4% EBIT margin. We expect EBIT margin to improve gradually from second half 26 onwards, as the new hangar will slowly ramp up their utilization, and the SIA contract repricing will contribute more meaningfully, especially with the probability of the performance and the delivery-based pricing model. And potentially there might also be like inflation-adjusted escalation terms. Therefore, we anticipate EBIT margin to rise by 1 percentage point year-on-year to 2.2% in FY26. And also PATMI margin will improve by around 0.5 percentage point to 11.7%. Yeah, and moving on for the industry analysis. Firstly, from the supply side, according to IATA, aircraft delivery has fallen significantly from the 2018 peak, which was 1,813 units. And in 2024, delivery are expected to, like even though the delivery in 2025 is forecasted to rise back to around like 1,800, this is still like falling behind the original estimates of around 2,200 units. Yeah, and for the demand side, since the delivery began to slow in 2018, they are very much unlikely to recover till at least like 2026. Yeah, so eventually there will be like 5,200 fewer aircraft delivered compared to pre-COVID levels. And for the demand side, global air travel demand continue to be robust, and IATA is forecasting a 5.8% improvement in 2025. And the strong overall momentum is primarily driven by Asian market, particularly Central Asia. And the graph below is the historical delivery of the aircraft from both Boeing and Airbus, and also the FY25 projection. Yeah, at the same time, SIA is experiencing aging in their fleet. Yeah, so on the graph, yeah, the aircraft are aging. That's why we believe there will be continued robust demand for MRO. And last but not least, there are some risks we would like to highlight. Firstly is supply chain risk. Since SIE really is pretty reliant on the limited pool of OEM and also like specialized part of the manufacturers, especially in the light of the current supply chain disruption. Yeah, we believe this might potentially lead to delay in check completion. And there's also currency risk since SIE operates across multiple markets and different countries. They might be exposing to translation risk due to currency fluctuation. And they're also exposed to commodity risk, such as rising jet fuel price, likely to pressure on the airline demand. And last but not least, there's privatization risk. Since SIA Singapore Airline owns 77% of the stake, which is the largest shareholder of SIE, and SIE remains very significant strategic asset for SIA, and since it's listed, it's subjected to different like scrutiny and different costs arising from being a listco. Yeah, so they might be facing privatization risk. Yeah, so we initiate SIA Engineering with a buy recommendation and target price of $3.83. And this is based on 26 times FY26 PE, which is 1.1 standard deviation above the historical mean. And this is reflecting SIA's improving operating margin and also robust outlook for MRO demand. And the multiple remains well below the industry average of the forward PE of 36 times. And SIE is currently trading at FY26 PE of 21 times and EV over EBITDA of around 30 times. And they also own net cash of 578 million. Yeah, that's all for me. I'll hand over to Paul for LHN. Thank you.
Yeah, thanks, Pam. Yeah, sorry. Just LHN provided an update. There were no financials, but I think the key highlight for us is that with the IPO coming up, there's a re-rating of their whole hospitality business. Next slide. So just to recap, LHN has probably three major businesses. They have the Collywood, which is a co-living. I think they have about 2,000 plus rooms. Then the second one is they have the industrial buildings, and also third is they have a work plus store, which is a storage business, and the fourth business they have is a miscellaneous. That they have car parks and all that, but those are pretty small. Car parks and solar and facilities management. That means manage like property management. So the key update was the listing of Collywood Holdings. They will hold at most 70% in this new entity, which will be listed on the main board. The market cap that was provided in the shareholder circular is around these levels, so we're not particularly sure, but we understand it should be at least 300 million and above. In terms of the update, no financials, but the occupancy remains held for the Collywood and the industrial space. Oh, sorry, my internet's a bit big. The other operational update was that the pipeline of Collywood remains strong. So there are about 2,000 plus rooms. There's another 776 rooms under construction, and that will imply like 35% kind of growth or under renovation. There's also this excludes 800 room healthcare worker accommodation contracts. So the Ministry of Manpower, they secured this contract last year. So there's another 800 rooms for bidding to due this year. So probably there's only 2 parties bidding, so we're not sure if they get it. But of course, if they can win, then it's another positive. It will probably double their capacity under construction. So these are for the foreign nurses that come in. These are not dorms. I mean, these are really like co-living with facilities. You need to do some social activity to assimilate them in. So for that, that's why it's not considered a workers' dorm. So only a few players are participating, probably only 2. Then once LHN, once Collywood Holdings is listed, so what would be the core reason any investor want to hold LHN? So the area that they're going to grow for LHN standalone will be the work plus store. So work plus store, it was defocused the last 2-3 years because there was a bit of a regulatory uncertainty about LTA allowing, URA allowing businesses to operate in this type of storage facilities. So in the past, storage was used by people like us. Maybe you want to store some of your personal items. But the demand has shifted not only to personal items, some put wine, to higher value items because it's a cold aircon facility, and also demand has moved to businesses. So especially those e-sellers or even any small business will set up shop there because it is probably the cheapest space you can find if you're a small business. If you want just a small room, I think you're talking about $3 to $4 per square foot. Of course, this is cheap for a small space. Because most industrial properties could be only one. If you assume the net profit for Collywood is around 13 million, because they don't really separate out totally, but if you assume that adjusted, the market is valuing the Collywood IPO historically at least almost 20 to 27 times. But I think with the growth, you're probably looking at maybe mid-teens and so forth. So that's why we have to, so there's a major re-rating of the whole Collywood franchise. That's why, although we maintain our earnings, we have to raise our target price. We used to be ultra conservative. We were looking at only 7 times, but because that was the market valuation, and now that we got transparency how the Collywood is going to be valued, that's why we raised it to 13 times. So we're valuing it compared to hospitality, but all those are huge hospitality, but those are almost like 20 plus times PE. With the listing proceeds, they will de-gear and then look for this. One area of growth, like we mentioned, is work plus store. We're not expecting any special dividends. Even though they list, there will be a gain, of course, but I think they will only want to pay off dividends if there is a realized gain, because this is more like a paper gain. They used to own 100, now they own 70, but they didn't sell anything, so there's no cash proceeds. And but they will, I think, because of the stronger balance sheet, they will probably try they will raise the dividends because of the stronger balance sheet, but no special. Next slide. Well, move on to Geo. So Geo, this was supposed to be done last week, but because I was away, so this report was done like 2 weeks ago. But they released their results. The most important thing was they're going to make another acquisition into work plus budgets. I'll explain later. Next slide. So the results was generally in line with expectations. The key thing that we focus always is, for those who don't know, again, Geo is a coal miner in Indonesia. But what makes them different is that they are spending almost 150 million on this new Howling Road and Jetty. So this road, it was going to raise their so anyway, this road is 98% land cleared. So that's important because there's a lot of local issues when you're building a road in Indonesia. And they have cut and filled, that means to totally completed about 1/4. The target is to finish this by 2020, by mid-2026. So the positive is the earnings jump almost 140% for the first half. Mainly driven by production. So production, of course, sales is the most important thing, but of course, production is important because they can also keep some for inventory. The negative was the coal price. If you look on the left, coal price is down 11%. I think coal price is now hitting probably $42 compared to their 46, roughly 42 or 43 that they recognize in the first half. In terms of the outlook, we actually lowered our earnings because of the prices are trending below our forecast, but we are not moving our DCF because we are just raising the probability, because our DCF also has a probability factor of how likely the road is built, because we don't put in the whole valuation. we maintain a buy recommendation. So just to reiterate why this road is important, because it makes them, if it's just a coal company, then I mean it won't be that exciting. But the key thing is there's this infrastructure business that they're going to go into. So they'll build a road, there'll be a jetty and now a barge in Sumatra. So upon completion, there'll be multiple sources of earnings. Of course, right now it's just selling coal. But the production will jump from this year 11 to maybe 25 when it matures. I'm talking about 2 to 3 years away. But again, once the road is done, I think there's better clarity in the production. So once the road is done, they will also generate toll revenue from other coal miners in the area. This could generate so if other coal miners ship 15-25 million on the road, because the road is 50 million, they are using 25. So that means they can sell another 25. And if you charge either $4 to $5, you're talking about 100 to or 200 million EBITDA. And you know, because there's not much cost in operating the road, it's already completed. So it's you're very lucrative once the road is done. Right now they've also I'll talk about it in the next slide. They acquired a barging. So once you ship the road once you ship the coal by road, you have to go to a jetty and there's a river. And I think in our SSP we always showed that. So the river has to ship it to the seafront. I mean, like a better word. And that also so they're going into that business. It's a tug and barge. Into this river transshipment of coal. And then the fourth thing, because there are people, I think they did mention there are interested parties looking to buy a stake in this road. So so they could sell a stake, I mean, just to kind of monetize the value. Next slide. So in terms of this road, I know it's very complicated chart, but on the left is basically details of they are buying 2 companies, but essentially the main one is the TMP. The details is on the right, the cash and all that. So they're acquiring 51% stake in 2 companies, which owns 27 sets of tugs and barges. Because one tug will pull one barge. One tug will pull a barge. That means it's an empty. There's an empty barge where you load on the coal. So you call it 27 sets. Although they were ×2 and call it vessels, but it's not really. I mean, it's just one set. Of course, we were of course worried because this is deemed a related party transaction. I think the shareholder owns at 30%, and the valuations are not cheap because you're talking about 33 times. So of course, but the transaction is strategic because once they get this vessel, they can immediately operate. So you're looking at middle of 2026, they can start operating all these vessels. So they need it urgently. And rather than buy 1 and 2, and you need the quality, they need to operate this themselves because the river is not really a huge river. It's a very not a massive river. So if you have operators that are not careful, you could actually jam the whole river, and this could affect you are moving like 1 million of couple 100,000 tons a day. So that's why they want to operate this, and also it's a source of revenue. So it's a huge opportunity if they actually move the whole 25 million or even 50 million eventually. And also we assume that if they load these 27 vessels, the valuations could be about 13 times. I mean, just stand alone before adding all this 25 million. So they're probably going to grow this business with more tugs and barges. Next slide. Okay, so for Thomson Medical, again, this is another delayed report. This was done 2 weeks ago, but so I didn't present. So let me just update everyone. So we think the recovery is underway, especially Singapore with the property windfall, with of course the Johor land that they have. Next slide. So for Thomson Medical, let me just remind everyone because not everyone follows. So they have actually 3 hospitals. Sorry, the main one is of course Thomson Medical, which we all know in near Novena. And near Novena, of course, not in Novena. Then of course they have a Malaysian hospital which is listed, and then they have a Vietnam that they just acquired. So the results were below expectations. The loss was wider than our forecast. Vietnam and Malaysia was weaker than we expected. We'll explain later. But the key one is Singapore is doing well. So if you look at the earnings, the EBITDA, Singapore has bounced by almost 20%. Vietnam continues to be weak. So I think what's happening in Vietnam is that the marketing, there's a huge competition that has sprung up in Vietnam. because of that, they have to spend more on marketing. And the other more unique event is that they're trying to tap into the national insurance business, and that they have to ramp up a lot of the staffing before they actually do that. So we lowered our EBITDA, but we actually raised our some of the parts 6, which is of course higher than 2025, although it's lower than our initial forecast. The valuation for we raised our land bank valuations to 1.5 billion because we are using a higher gross development value. Their gross development value is 18 billion, ours is 17. So we do expect parts of the land in Johor to be crystallized. They will be launching one high-end residential unit. So our recommendation is from neutral to buy, because we think Malaysia there's a recovery in Malaysia also, because the insurance business half on half has turned around. But you can't see year on year, but half and half. Because they are no longer giving such high insurance discounts. And because in the past they lost 2 insurance companies, then they have to give a very high discount to the third, and I think the third and only insurance left with them. Next slide. So these are the various updates. I won't run through everything, but the key thing is that Singapore is turning around, because Singapore used to be only deliveries and so forth, but now they've added oncology. They add in more chemotherapy chairs, because they're working with this group called OncoCare that has a bunch of oncologists or cancer treatment. So they're also moving into orthopedics. So what has happened is that the whole Thomson Medical hospital now is upgrading from just deliveries to more higher end treatments. They are outside of O&G, which is obstetrics and gynecology. Malaysia, which we mentioned, was hit by insurance, so that is turning around, lower discounts. Malaysia is also they are working with OncoCare and introducing more oncology since December. So this is a bit more mature in terms of the cancer treatment care or oncology. And they're also beginning to see more medical tourism, especially from Indonesia. So Vietnam will be big. So Vietnam is still big because we mentioned earlier the marketing. And of course, the main one will be the Johor. So they have roughly 11 hectares of land with a plot ratio of 11. So this is, I don't know how many floors. I mean, have a plot ratio of 11. But 1.5 hectares of it will be for the hospital and so forth. The rest is another 1.5 is like medical suites. So virtually their remaining 9.5 they can actually sell and develop. So the details are not out, and they probably not even finalize it themselves. So they could either sell it or work with other developers to develop this piece of land. And of course with the SEZ will give them will be another key driver in terms of giving them tax incentives, and also it will be it can load them with more patients and so forth. Okay, let me just move on to the weekly very quickly. So we have our Singapore weekly. I won't run through all this. I've got nothing. Just go through, next slide. So in terms of a tactical view, so of course the market is now pricing in 100% certainty of a rate cut on 17th September, by the Federal Reserve. So even though actually inflation is still stubbornly high in the US, and it was within expectations, so I think the market has accepted it. But the key thing was the data, the labor market in the US continues to be weak. So the 2 data points was the first one is initial jobless claims. So these are if in the US, if you don't have if you want to claim unemployment benefits, they do have a weekly number. So this is 263,000 in the September week, and this is the highest if you remove pandemic since 2016, like a 8-year high and so forth. The other weak data point coming out on the labor in the US is that every month you hear all these payroll numbers, they're all over the news. So actually the last 12 months that they did up to March, they said that they need to revise it 50% lower. So whatever number you saw was all fake, in a way. It should be 50% lower. Usually it's a bit higher than expected. Maybe in the end, probably 20-30% lower. So what it just says is that the payrolls in the US is much weaker than expected. But nevertheless, I think the macro backdrop for the US market is positive, I think, in our view. So a couple of reasons. So firstly, as the Federal Reserve is cutting interest rates, over the next 12 months, you're looking at almost 5 to 6 interest rate cuts. At least that's what the market is pricing. But we are beginning to see the long bond yields, which is the 10-year, the 30-year bonds in the US start to slide from the highs. So this is positive because it will raise the valuations of assets. The second thing is in our view, I think with Donald Trump taking more and more control of the Federal Reserve, especially when Jerome Powell is replaced in May, we think monetary policy will become like a fiscal tool, which isn't good in the long term, but I think in the near term is good because you know that if it's a fiscal tool means you want to stimulate the economy. So he will see cutting rates as a way to stimulate the economy, yeah, not to contain inflation. So it will probably be more and more interest rate cuts. The third thing is the latest data point we got was that corporate spending is actually doing very well in the US, better than expectations. One of the reasons is, if you recall, Donald Trump launched the One Big Beautiful Bill, and in this bill, if you spend on your capex, let's say you spend 1 million on a factory, you can claim tax deduction of 1 million immediately. So of course, everyone will take advantage of it because you can cut down on your taxes. In the beginning, yeah. Then the other thing, of course, midterm elections in the US is only next year, but I think the prediction markets suggest that the Republicans will probably lose the House, and this is generally viewed positively by the market when there's a split government. So we think the macro backdrop for the US is positive. In terms of the SGX new index, we think it's going to be positive. Of course, we're not sure how they're going to measure this, but it's positive if they can attract passive flows. Yeah. The value unlock package, there's also going to be a value unlock package announced by the MAS. We think it's going to benefit more investor relations. They probably, this is our guess, we have no idea. They probably might co-share with small mid-cap companies when they want to do investor relation activities, or even hire an external investor relation person. These are some of the key things. The main one is the FOMC meeting. Of course, there's this TikTok deadline. I mean, yeah, not sure what's the impact like. Next slide. The one on the left here is just the payrolls. So although you know the payroll numbers, but if you split the payrolls, which is jobs are in the US, the red line is more non-economically sensitive. I know these are like government jobs, healthcare, social worker. So that is holding steady, but the private sector is the one that's coming down. And because you're going to do, like we mentioned earlier, a big revision, most of it is private sector, that blue line is going to come down even more. The one on the right is the jobless claims, initial jobless. That means people can't find job, they're going to get unemployment benefits. Although it is a big jump, but it's still quite low compared to historical standards. But it's the trend that people are worried about. Next slide. This is the chart on the left is a way to measure corporate spending in the US. So it used to be trending down, but the last 2-3 months you see a big spike in corporate spending. So we think it's the stimulus. The tax incentive by the One Big Beautiful Bill. The other thing is the interest rate. So interest rates is starting to slide. We're talking about the 30-year, 10-year, and 2 years. So that is going to be a positive for the market. Next slide. So the one on the left is all the various types of inflation, but you notice everything is actually going up. So the green line, which is the goods inflation, is also going up. The only one is shelter. So it's not like inflation is trending down very sharply, but even then the Fed, we think, probably going to. So this is the one in shaded is 2026 in beige shaded. The one is 4th quarter. So the market is looking at maybe 150 basis points cuts. So you're talking about 6 cuts in 15 months. Yeah, that's what the market is pricing. Next slide. Do I have any more? Oh yeah, okay, that's the end. Yeah, sorry, everyone. Yeah.
Thanks. Yep, I can take on some questions. Yeah, sorry. Hey Ben, why is there no Marvel? I mean Marvel. Yeah, I think currently in our Semicon quarterly we track the bigger companies. Marvel currently their market cap is only 68, so it's still quite small compared to the rest. But I think if there's thanks for the feedback. I think if there's more interest in Marvell, I can include it in future. Yeah. I think their most recent development is that they are working on a custom solution together with NVIDIA using their NVLink technology. So it is also positive in the same light as Broadcom. Yeah. Let me see. So is it better to accumulate Centurion or participate in the Sen REIT? Yeah. So I think in my opinion, it depends on your investment objective. I think Centurion REIT gives a better kind of dividend DPU yield annually. So if you're an investor that goes for dividend yield, I think it would be better to go for Centurion REIT. But I think for Centurion CCL itself, the main investment thesis would be would be because they have a better balance sheet. So going forward, it will be their kind of future growth opportunities going ahead. I think currently they have a lot of strong interest in Malaysia's worker dormitory. And the story is because with the JB SEZ going on, there may be more construction demand going on in Malaysia. So I think they are also exploring Middle East regions for worker dorms in terms of their oil and gas industry. So there is I think the answer would be to depend on whether you are going for dividend or in terms of growth prospects. Yeah. Will Centurion TPU in specie be dilutive to their share price? I don't think so, because Centurion announced they will receive 45% stake in the REIT divestment itself. Then after they give out the dividend in specie, they will be left with about 35 to 40% of the stake itself. Yeah, so the dividend in specie is given off from what they receive. So there wouldn't be any new shares being allocated. Yeah. Okay, there's a question with 4 parts. Okay, the first part is, when will SenREIT be IPO'd? They are targeting their IPO to be 1st October. So that is their target. Do you think it is a good timing for SenREIT to IPO in current interest rate situation? Yeah, I think so, because as you all know, interest rate is dropping. So I think currently, in terms of their PBWA assets and Centurion's assets itself, they hold about 50% of their borrowings in floating rates. So with the interest rates coming down, their what's that called? Finance expenses will drop as well. Where will Centurion stand in competition? They have, I think, competition in terms of if you talk about worker accommodations first, I think they are quite established. They are the biggest player in Singapore. They are the first player to come out with the dormitory standards, which fits the Ministry of Home Affairs, MOM standards for worker dorms in 2040 itself. So that's the long-term trend, and Centurion is the first one to come out with that. And currently their market price is about, their rental rates is about market price average. So I think they stand quite well in terms of their worker dormitory competition. In terms of their student accommodations in UK and Australia, currently there's local competitors, but I think because the supply-demand dynamics is very healthy, because there's still a severe shortage of student accommodation beds. So Centurion still stands quite well in terms of competition over there. Who are the S-REITs that Centurion can compete with? There's no direct comparables, because in terms of REITs itself, from what I know, Far East Orchard, they own Far East Hospitality Trust, but then the Far East Hospitality Trust does not own any student accommodations. It is the parent company that owns Australia student accommodations. Yeah, and also for Mapletree Investments, I think they have 3 REITs, but the three REITs, they don't own any student accommodations. It is the parent company that owns Australia PBSA. Yeah, so if you ask in terms of this, hopefully that can give you some insights. Yeah, thanks. Yeah, I think the latest question is the Centurion stock price dropped a bit after REIT listing announcement. Is this a concern? Currently, my view is I don't think so, because I do think that currently the stock price is still being supported by their dividend in specie expected distribution. So they are expecting to give out about 7.5% of their stake. And that's one. Secondly, they will continue to own about 37.5% stake in the REIT itself. So they will continue to support their bottom line. And I think going ahead, they are also having a stronger balance sheet, which positions them better to go to identify more growth opportunities. Yeah, so I don't think this is a concern. Centurion is considered industrial or hospitality trust. If yes, will they also face competition from others within this sector? Industrial hospital. I think it will fall more within the. I think it's a bit of a maybe more within the industrial, because if you see in terms of worker dormitory, it's more like the construction works. But I think in terms of student accommodations, they also have the higher tier episode. So that one will be targeting more high-end student accommodations. So I'm not sure. I don't think that's within hospitality, but I think more towards industrial. Yeah. Thanks. I think that's all from my end.
Hi, okay, maybe I could take this one question. So Fahmi, among those software company you shared, which of these top 3 companies that you would put into your fund? All right. So among the companies that we shared, I think 3 companies that might sound interesting are Microsoft, Adobe, and some of the cybersecurity companies. So for Microsoft, if you look for companies that could provide stability and some of the growth factor, Microsoft might be suitable for you. So like Microsoft is, they remain one of the large cap companies in the market, as they could offer you a defensive characteristic, and also at the same time, they also provide some of the long-term growth, especially in the cloud and AI sector. So they also one of the companies that provide recurring revenue base because it is software product based. So they are defensive in nature, that when you look at it, they are one of the companies that rebounded higher after the liberation days in last April, so that even when most of the software companies didn't rebound that high as much as Microsoft, but Microsoft is deemed as one of the most defensive companies in the sector. So growth, Microsoft also, but at the same time provide some of the growth outlook for that they are one of the leader in the cloud and AI companies. So their product, which is Azure, which is the cloud services business, is one of the cornerstone of the what most of the companies subscribe for AI and cloud services. That even in the next quarter, they projected about 37% growth year-over-year for these companies for this particular segment growth. Yeah, cloud and AI. So moving forward, we do think that there's still more room for their product, for their cloud and AI to grow further, because they keep hinting that the management keep hinting that there are more demand for the cloud and AI, and demand for AI. They say that demand for AI and cloud is outpacing the AI capacity of what they could provide. They are also still outpacing the infrastructure of what they could provide. So, and they are reported some of the capacity constraint in the next few quarters, but still there's more room for this segment to grow. So if you look for companies that could provide stability, as Microsoft, that is defensive in nature, and also some of the growth factor, then Microsoft might be suitable for you. Next company is on Adobe. So Adobe is like the creative product software leader in the market. Their products are what people most and already use in the creative industry. For example, products that we are familiar like Photoshop, Illustrator, some of these products are called the gold standard by the market. They are also subscription-based models, so they provide visibility in the financial and earnings. And so Adobe also have some sort of economically, they provide a lot of products that is in one economy that it is unlikely that most of the enterprises whom already uses their product would switch to the other competitors because they would prove to be high switching costs. Because if they want to add one or more products for this that other than the Adobe, that is actually makes more sense for them to just add up one of the new product that Adobe would provide. So it's like instead of switching another platform altogether. So there's in a way that it is a very high switching cost, like high barrier to join to entry the creative software. But when it comes to growth, the story about Adobe is whether their AI monetization of their product is fast enough or not. So basically the timing monetization. Adobe mentioned that their current focus right now is to improve the traction of the product first. But their AI application is already embedded across their products through the freemium model. It means that you can use some of these AI applications for limited use, but you have to pay more to unlock more of the use of the AI. So we think that for price to really, we might need to see and wait for faster monetization rate of AI related product from their side. But because the AI related product currently only make about 5% of the total revenue, so it's not that big. It's actually small. But we do see potential for AI related products for Adobe to grow further, especially because Adobe already have that huge base of subscribers that they already built out since many years ago. So it really is depend on whether Adobe can make use of that and grow the AI products. But we do see more room for the AI to monetize. And lastly, that also seems interesting to me would be the cybersecurity companies. So this is proven. You look at both Crow, CrowdStrike, and Palo Alto, both are growing their ARR at the 20 to 30%. And moving forward, we are going to see more and more companies adopting artificial intelligence into their business process. I mean, you look at a hyperscaler business, for example, Microsoft, who provide this cloud services business. Their segment of this business grew at 99% year-over-year because they are used mainly to cater to increasing need of AI. You need high computing power to process AI and provide AI offerings. So thematically, as a management highlight, there is an increasing need for cybersecurity, especially for companies that adopting artificial intelligence. And as more and more companies adopting AI, it makes sense that you can that more and more need more and more companies to adopt cybersecurity because the increasing concern of security incident over the use of AI, right, might seem as a threat from the outside external perspective. So the other thing that we also think that is companies scale their AIs, so there's also needs for them to have more security, more advanced security, because when we talk about security, cybersecurity is like a non-negotiable spend, because you as an enterprise, you wouldn't want to risk your company's data lose to cyber threat, because especially when it comes to IT, it's very sensitive that even one ransomware hacking sometimes could wipe out the whole company's data. So in a sense that as people are using more and more AI and the use of AI is becoming more prominent, there would be increasing threat from AI. So you would need higher cybersecurity. Yeah. So those are the three companies that we think look suitable for your fund: Microsoft, Adobe, and some of the cybersecurity company. Right. That's all from me. Thank you.
I'll
Sorry.
yeah, go ahead, please.
Okay, thanks. Yeah, I think there's this question about the DBS. So the question is, DBS share price tumbled below 52 this morning. Is this knee-jerk profit taking or more sinister lower net interest margin, net interest income forecast going forward with the Fed cut this week? Yeah, so I wouldn't say, sorry, excuse me. I wouldn't say it's tumbled. If you look at it, even if you expand it to 1 week, right, it's still up, right, at quite a record high. It just went below that 52. It didn't really hit 53. So I would say it's really more of profit taking, right? I think the reason why it went up was also partly due to JP Morgan re-rating it, and increasing their target price. So it's really a lot of profit taking. I don't think the like what you said, the sinister lower forecast for net interest margins and net interest income is what really pushed the people to sell, because that was already priced in before that, right? It was expected that the rate cuts would come in, and even then we could really see from the Singapore interest rates that it's been declining without any rate cuts. So the fact that the Fed's gonna there's quite a near certainty that it's gonna cut rates, it won't really move it much, right? So it's really expected to decline. So I don't think it's anything to do with the lower net interest margins, net interest income. And like I said earlier also that DBS is probably the only, I think, the Singapore bank that's able to maintain their net interest margins and their the net interest income is really from the huge influx of deposits that are coming in. And that's how they are able to capture most of it, because they can take advantage of the fact that they are the largest Singapore bank, right? And then that goes to another question as well, which asking, it's a good question here. Why? Hold on, let me try to find it. I can't find that question. Sorry, but I think if I'm not wrong, it's asking, why customers are exiting the US dollar market for Sing dollar. Yeah, I think this goes back, quite a while ago, the moment that Trump, started to announce a lot of tariffs, in his Liberation Day. It's really a lot of geopolitical uncertainty, and then I think in general, investors would like to put their money in a place where they can better predict, and it's more stable, right? In a more stable environment. So with Trump, at any other day, you could just expect him to come out with a new tariff or a new policy that goes against what people are predicting, right? Then this, or even just on his Truth Social or the social media, to start blasting the Fed head, right? And just quoting anybody. That shows a lot of uncertainty, unpredictability. So that's the main reason why there's outflow. And it's not just to Singapore, right? It's to Hong Kong as well, which is why we see the HIBOR also decline quite a bit. Yeah. So I think that's the question. Yeah. I think that's all the questions. I'll hand it over to the rest of my colleagues first. Thanks.
Yeah, thanks, Glenn. I'll take the 17 Life question. Any update on 17 Life? Yeah, so we believe their MAU monthly active user has already bottomed out since like revenue actually had a 2.2% quarter-on-quarter improvement in second quarter 25, since paying ratio and average pay per user remain the same, meaning their active monthly user actually bottom out after the cancellation of the exclusive contract thing. Yeah, so all of the streamers will be free to stream on multiple platforms. And they are also very active on doing the marketing, like offline events. They did have a pitch, they did have a football event with the top streamer on TikTok. Yeah, and they're collaborating with some like sports brands in Japan, which is pretty trendy in Japan now. And yeah, something important is they value shareholder return. That's why like they actually announced dividend. They announced like 1.5 cents on dividend in first half 25. Yeah, so there's no fixed dividend policy now. Yeah, but this is a pretty good sign for 17 Life. And they are also remain committed to their share buyback plan. Yeah, so far they have purchased around like 1.8 million in terms of the absolute dollar value, which is around and they're still holding like 82 million net cash, which is around 56% of the market cap. Yeah, and we do believe catalyst will still be coming from the very lever live streaming businesses. Even though the absolute contribution remains small, yeah, to the group level. Yeah, and they're also expanding the e-commerce site. And they are launching a portal in Japan, which is catering to the B2B services. and which will help the business to expand on their e-commerce presence. So they will provide streamers. They'll also train the streamers. Yeah, and they'll handle the logistic for the business part. And in return, like customers, it's a subscription-based model. Yeah, so customers will pay monthly subscription fee. Yeah, that's all for 17 Life. And there are some question on Yangzijiang financials. Will Yangzijiang Financial having lags now before spin off? Yeah, well, I personally believe the spin-off story has been pretty well communicated. Yeah, and now they are trading at 1x book value, which is much higher than any of the China bank or even like the Hong Kong side asset management company. Yeah, and the actual spin-off may probably take place in November this year. And there's also a 250 million placement before that. They are targeting at institutional investors. So further catalysts might probably be coming from the placement, whether they can expand on the existing investor profile. Yeah, so get some like a well-known cornerstone investor. Yeah, probably that might push the stock price higher. Yeah, but beside that, I think the whole spin-off story has been pretty well communicated. Yeah, that's all for me. I'll hand over to the rest of my colleagues. Thank you.
Yeah, thanks very much. Yeah, there are some REIT questions. Let me take on some. Outlook for overseas REIT, Prime US REIT, Daiwa House, Keppel Pacific Oak REIT. Yeah, so for Prime US REIT, yeah, things are looking good. Yeah, the share price also really rallied over the past few days. Yeah, but for them, there is we can see the bottoming out of the US office, like rental reversions has been positive. So signs that they are no longer kind of buying occupancy at a lower rate, basically giving more rent provisions. Basically the rent-free periods are in line with market, like 1 year per every year, 1 month per every year that they sign. So the leasing terms are looking okay. That's for Prime Street. They've also signed some significant tenants over the past few quarters. So all these will start to contribute over the next few quarters, as you all know, there's a rent-free period and such. So once that's over, then they'll start contributing cash. So going forward, we believe next year Prime will start paying at least a 50% DPU. So that will bring the yield up to about 9% from the current about 2%. Yeah, so things are looking positive for Prime US REIT. Daiwa House Logistics Trust, relatively stable occupancy. Rents are still flat, but they have some upcoming non-renewals that contributes about 50% or not 5% of the NLA. So there might be some positives there, as we've seen in the past quarter that they managed to release some of these expiries at a higher 10% rent reversions. As you know, in Japan, it's quite hard to get positive rent reversions, and basically their leases have no escalation. So with these expiries, we are hopeful that, or rather, it is possible that there's a chance that they can renew these leases at a higher rent. So that is for Daiwa House. I read the Berlin campus redevelopment, that one still some uncertainty, and the fact that the office space also is a little bit of weakness there. So we foresee some extended vacancy period. So for iREIT, they're still facing some headwinds. Yeah, especially from the income vacuum from the Berlin campus. And yeah, Core, kind of a similar story to Prime US REIT as well. We're seeing some bottoming out in the US office, so there is a recovery, and it is likely that Core will also start paying some dividends starting next year. But Core currently is not paying any dividends at all compared to Prime, where they're paying like at least a 2% yield, 10% of their distributable income. Yeah, so I hope that answers all that questions on REITs. Let me find that again. It jumped around. Does Centurion REIT add value to those owning Escort REIT? Good reason to add Centurion REIT to a REIT portfolio. After all, Centurion REIT is in the PBSA. Escort, they do have some as well, but Escort do not have the PBWA. So for PBSA, Escort has some PBSAs there that are doing quite well, 95% occupied, at least. Yeah, so if you ask you whether you can add that, yeah, you're just adding some exposure to the PBWA space and more PBSA space into your portfolio for the REITs. Yeah, I think that's a very good answer. But yeah, like 7.5% yield, it is kind of similar yield to what Escort is trading at as well. Yeah. Think that's how to say for that. Thanks. Yeah, I think that's all for me. Hand over to my colleagues. Thanks.
Thanks, Darren. Let me just try to answer some. There's a few questions on Thomson Medical. So with the latest announcement of the massive development project in JB, close to RTS recently by Thomson Medical, is there any upside in the near future for this stock? Those are laggard now. Yeah. So in terms of the news flow that we're expecting, there's definitely going to be a news flow the next 2 to 3 months or longer, definitely. So one of them will be, of course, they're going to launch on their own residential project. You should also expect the hectares of land that they have. They will probably announce some partners. So that could also get the market excited. Operationally, they won't announce anything until the next 6 months. So you won't see much in terms of operations, but probably the listed company in Malaysia, that would also show a turnaround. So there is a string of news flows, and that should try to reinforce them being able to realize the value. So there is, so the market is fair. I mean, not to hit those target prices because they want to see more clarity and development in the Johor project. So that's what we're expecting. So we think the price action would be positive. I think considering the whole market these days, any positive news for small mid-cap stocks, it can rally. So we are looking for some positive news coming up. Yeah, residential projects, some partnership with there'll be some parcels of the land working with partners. So that's what we're expecting. Yeah, thanks for the question. What is the Thomson listed Malaysian entity? TMC Life Science. They own 70% of it. Yeah. So they were making losses actually because the discounts they were given was too much. Alltech share price has doubled. Is there any more upside or is it time to take profit? We still think that there is, but obviously the valuations is higher, so it won't be the appetite for everyone. But what we're looking out for is more contracts in South America to be announced, and some and maybe 2 or 3 more in Malaysia. But most important for us would be not just contracts, but some projects where they can take an equity stake and earn recurrent income. For those who follow Malaysia, something like a Gamuda, you not only just build the road, you have a stake in the toll road itself. So that's what we're looking for, and they have the balance sheet to do it. So that will be the thing. So you will still get news flow on contracts, then to get the recurrent. The Indonesia, the big one in Pertamina, I think with what's happening in the politics in Indonesia, that's probably going to be delayed. So that's where we are, what we're expecting from the next couple of months. There's a lot of questions. Any comments which shares will be included in the new STI index? Will ComfortDelGro, WeHer, SPIL, Zhang likely be included? So I really have no clue because we do not know how they're going to measure. This is very subjective, right? Corporate governance. But if you look at some of the past award winners, I mean, I can only gauge from those who normally win a lot. Okay, LHN used to win a lot. Jianhu also win. I'm not sure you're going to buy that share price, but I think Jianhu is another one. Hong Leong Asia has been another one that has been winning quite a lot of those corporate transparency awards. So these are some. My own guess, if you want to put dividends as one of a corporate transparency, because that's a bit more measurable, paying consistent dividends, that would be my own thoughts would be Propnex would be one. Sheng Siong will be another one. They have been consistently paying dividends since IPO. And the other one that also wins a lot on the awards and also pay dividends is Micro Mechanics. So again, this is very subjective. So I'm really not sure how they are going to measure this. I mean, it's like picking what is your favorite dish. You know? Yeah, it's very subjective. Yeah. Paul, Del Monte Pacific, please with the recent results, please share your outlook. Okay, I apologize. I didn't listen to the Friday call. I just didn't have the time. I'll try and listen and maybe do a Phillip on the ground. But the earnings definitely turned around. The earnings up 40-50%. Of course, maybe 4 percentage points of it is come from the weaker US dollar, but even if you remove that, they're still growing about 40-50%. So the turnaround is there. The one big share overhang, not share overhang, which can be a positive too, is they definitely need to do, my own view, they definitely need to do a rights issue. So the balance sheet is still weak. They will probably do a rights issue. I'm not sure how the market will respond. But to me, a rights issue is actually positive. I know because that is the one thing that is the one weakness for this company. So Del Monte, uh, actually they have a very dominant share in Philippines. So they are very, very strong in Philippines. Just that when they bought the US operations, then of course the focus and everything just dragged them down. Now that they are back to Philippines, then of course it's a positive news. But I don't have the valuation and numbers. I need to get back to you on that because I didn't listen to their call recently. I'll try to join their AGM also if I can. SIFNet in what business? SIFNet, I'm not sure about outlook. I think Myanmar can tell you about the outlook. But in what business? So you can think of SIFNet like a construction engineering company. More on the engine. They are involved in normal construction of infrastructure, roads, and so forth. They are also involved in infrastructure of mining. When you do mining facilities, they're also involved in that. And the third one is defense. So the share price took a hit in the past because the defense was a disappointment. They were supposed to get some, if I'm not mistaken, don't hold me to it, it's some patrol vessels or some defense or marine related to the army or defense related vessels. But that disappointed. I think the Australian government cut back on that from, I don't know, I think cut back half of the number of vessels they wanted. So I think that hit them quite badly. So, but I'm not sure of the outlook. I didn't really listen. Has the US factored in the likely interest rate cut this week? If yes, what do we expect US markets to shoot up after the announcement? Yeah, I think the rate cut is definitely factored in. What is not factored in is what Jerome Powell is going to say. And of course, you also have the summary of economic projections. So this will give some guidance. Of course, it's I wouldn't say forecast, it's more like guidance what the Fed officials are looking at in rate cuts for 2026. So I think the market will react more on Powell's speech and that summary of economic projections. So the SEP, I think, yeah. So that's where in the dot plots. Sorry, another way to say is the dot plots. So people are looking at dot plots and what Jerome Powell is going to say. So if he's sounding more bearish on the US economy and more dovish, then means you might want to cut. So it's more the outlook rather than the rate cut itself. I think everybody knows there's going to be a rate cut. We usually Zane and in future our credit analysts we normally do every quarter we'll just do some key highlights of the Fed meeting. So just look out for it on Monday when he presents. Any idea on the index? I really do not know. It's probably some corporate governance related thing. Yeah, but I really no idea because they give very little details. Can you show the target price slide? Can someone show that the target price of the US stocks? Whoever's in charge of the new index that tracks listed companies beyond STI will be a driver for local retailers to plow into mid caps. Yeah, which counter will benefit the most? Yeah, it's the same answer. Yeah, it will definitely benefit the mid caps because whoever in the index would definitely get one pool of money. Yeah. Who's in charge of the slides? Yeah. Okay, is there possibility as per lifestyle? Yeah, I think the same question. I really not sure, but maybe Yang Zhejiang Finance possible. Yeah. But UMS, I'm not sure. They never really win any awards or this corporate government's awards. Delphi, please comment on potential upside. Yeah, we didn't follow. They didn't do a briefing. They cancelled it. Yeah, I think they want the slide on the target price of the US stocks. When is the replay released? How do we access? Yeah, you can get our replay in the PhillipCapital YouTube channel. We should upload it in after 2 to 3 hours. Thanks for the question. Can we still apply for the Collywood IPO? Yeah, I think it's not open yet. It's still at the placement stage. So I think it's one step behind. Yeah, I think the prospectus is not out yet. So yeah, I think they're still available. It's not officially launched. They will probably only do the Collywood listing in November because they need to delist the Hong Kong, get the complete delisting of their Hong Kong dual listing. Then only they will do the IPO. So it's probably only going to happen in November. Yeah. How big is LHN in the self-storage space? I don't have a market share data. Sorry, I don't have it. They have, I think 4 to 5 facilities. If I'm not mistaken, sorry, son, I don't have the exact number. But it's in their slides. They actually do give details. I think they have 4 to 5 facilities of that. There was virtually no growth the last 2 years because I think there was, like you mentioned, some regulatory uncertainty. Hyper, what's dragging ComfortDelGro price from going up? Any heavy baggage behind? There's really no heavy baggage. I think one possibility is that the market, when they acquired the CityCap 49%, I think the market just took it very badly. The market didn't like that they're increasing their stake in taxi business, which they are in all along. I mean, so I think the market just didn't like that. Although now you wouldn't want to call it CityCap, I just call it ride hailing. Everyone's a ride hailer now. That's one thing. And also, the acquisitions that they've done didn't really materialize the kind of strong earnings growth that everyone wanted. So they're still growing. I mean, 8-9%. There's no issue with that. But because their balance sheet, the gearing really spiked up from net cash to net debt. Maybe 300 million, if I'm not mistaken, from 300 cash to 300 million. Roughly those numbers are again. I think that's what concerns the market, that the acquisitions is not giving the kind of growth. Because one negative is that in the first half results, there was a change in accounting where they had to recognize amortization of the goodwill of what they acquired. So that dragged down the earnings. So those were the so-called baggage, I like a better word. Operationally, things are still doing well. I think UK will be the one that will do well. And if they're also securing some MRT contracts in operating MRTs in Europe. I think Stockholm and I think, yeah, one is that in Stockholm. Yeah. So that's where the growth is coming from. Yeah. So I think that's the main thing why the thing is still lagging. Raffles Medical Group has a hospital in Vietnam. I don't think it's a full-fledged hospital. It's more like a medical center, if I'm not mistaken. Yeah. Does it face a similar competition? It probably does face, but I don't think it's not a really big hospital. It's more a medical facility, and the contribution is very small. Yeah. The competition Thomson is facing is from some of the local chains. So what has happened is that there's a lot of capital, apart from, of course, Thomson, a lot of capital, a lot of private equity went into the medical space in the healthcare space in Vietnam recently, the last 2-3 years. I think it's in my note. Some of the names I just slipped my mind. But I think as a result of that, I think there's a lot of. I don't have the number. They don't meet. We haven't met them, but I think for like we highlighted. Oh, sorry, my line is pretty big. Oh, okay. Anyway, for us, we still like offshore marine vessel operators. We like we mentioned 2 weeks ago, I think the outlook is positive. Middle East is really ramping up production. So because of that, they need a lot of these offshore support vessel operators. And number two, supply is just very thin. I think it's only 4 to 5% of what is being ordered. It's only 4 to 5%. Yeah, or compared to the existing order fleet. And the order fleet is aging quite rapidly because after the 2016 crash, right, I don't think anybody bought any vessels. Yeah, so even though oil price might be down, and of course recently the bounce in the oil price also helped sentiment. I'm talking about Marco Polo, ASL, Pacific Radiance, and even Penguin. Of course, Penguin, there's no volume there for you. Okay, Hypo, what's the impact of long-term bond yield sliding? I think when bond yield slide, it will push up the valuations, also lower the cost of funding. But I think cost of funding is more short-term rates, but it can also revive a bit of the US mortgage market, the housing market too. So it will raise valuation and of course help pick up some activity. Because I think long-term bond yields impact the mortgage rates in the US more. Yeah. Okay. What if the Federal Reserve cut 50 basis points instead of 25? Will the US market soar? Maybe in future. Yeah, I don't think the market will soar. I think the market will be a bit very cautious. I think what you do not want is the market to worry that the Fed is being very political. I think it's better that Jerome Powell say that he will cut rates, but in a gradual manner, and then the dot plots show that there'll be more rate cuts in the next few months, the next 12 months. That will be most ideal. If you cut too much now, then people worry because there's no discipline by the Federal Reserve because Donald Trump is controlling it, which eventually will happen, but at least not so near, not so soon. That's my own view. But thanks for the update on Thomson Medical. Can you put up the second slide again, which relates to the Johor SEZ? Any chance to have medical? Yeah, thanks for the feedback. I actually just message them and try to see if they want to do couple insights. Yeah, so thanks for the feedback. So no, when we get feedback, we will try to reach out to the company because sometimes we do not know what people want to, what webinars investors want. Is it better to go for LHN or the REIT spin-off? I think in the very near term, this is very, very near term. Before the IPO, maybe the LHN, then there'll probably be news of it going, the actual listing, then maybe the news of the actual listing then and the actual market cap, that might actually surprise the market. Then maybe LHN might go one more round. Then maybe switch to Collivu. Yeah. So I think LHN might still get another run. I'm not saying how much, I do not know how much is a run, but might get another leg up because the eventual listing, because right now it's just the approval. You do not know what's the size of this IPO, what the take up, who's the investor. So when all those comes out, something like what Centurion just announced, then there could be another leg up. Again, this is just my own view. Any thoughts whether a bigger or smaller first freight crowd will be positive or negative? I think it will be market neutral. I think market is looking more for the forward rate cuts. So it's a done deal. It's more how many more is coming up. Yeah. And of course, all this also depends on inflation data not going out of whack. If Jerome Powell say that he does expect inflation to climb, but it's temporary, that transitional problem thing again. Yeah. Coca-Cola, yeah, sorry, we don't cover. Yeah, Coca-Cola, yeah. Our US coverage, we focus more on technology. Yeah. Okay, so I'll leave it to Myanmar and the rest. Yeah. Okay, so let me answer this, and I'll leave it to all of you. Hi Paul, is the Fed rate cuts and inflation good or bad for Geo Energy? Yeah, rate cuts is positive for Geo because they are borrowing money and they pay in US dollar to buy the road, the 150 million road that they're going to spend on. Last one for me, hi Paul, how many? Maybe 2 to 3. And then 2026 also 2 to 3. So in total, so you just imagine that this is a market that you're going to get like 6 rate cuts in the next 12 to 15 months. So that's why we think it's probably going to be positive for the market. Yeah. Okay, I hand it over to the rest. Yeah, thanks.
I'll take the 17 Life. Further to the 17 Life update, since they are buying back shares, will it cause the counter to be even more illiquid? We personally believe this is a good sign to the stock actually, since after share buyback, there will be improved ROE, and also it's a good signal that the management is actually confident about their own stocks. Yeah, so their mandate is to purchase up to 10% of the issued share capital, and currently the free float is around 51%, below 55%. Yeah, so which is still pretty liquid. Yeah, hope it answers our question. And can I say Yangzijiang Financial share price 1.18 at the moment is already a fair value and pricing the spin-off story. We don't cover Yangzijiang Financial, so we can't really comment on the fair value. But comparing to their peers, which is really trading at 0.8 times PB, for the listco in Hong Kong and yeah, Singapore listed fund management, they are around 1 times, yeah, so which is at a higher range, yeah. And the whole spin-off story is pretty well communicated. Yeah, hope it answers your question. I hand over to the US team or the rest of my colleagues. Thank you.
Yeah, maybe excuse me. Maybe I'll just take on this. I think last one. Sorry for the Google one. We'll get back to you. Because the analyst is not here today. She's on leave. But yeah, we'll get back to you on this on the Google one. But I'll just answer this last one, I guess, on the outlook and TA for the 3 local banks. So yeah, Zane is not here, so there'll be no TA. But you can check out my banking monthly report. We actually put in a TA section now for the 3 local banks and SGX, so you can refer to that. I think it should still be quite up to date. But anyway, for the outlook wise, for the 3 local banks, I spoke quite a bit at length about DBS. So DBS is our topic mainly because of the ability that their ability to capture more deposits that are flowing into Singapore, and then they're able to turn that to lower their cost of funds as well as to improve their net interest income, and also the fact that they have the most I guess the most predictable dividend policy as compared to the rest because it's fixed. We know we're going to get $3.06 for full year FY25, regardless of where their PATMI goes, right? And also they have, I guess, committed verbally, right, over the call that they will be extending their step up, dividend step up, yearly dividend step up in 2026 as well, right? So that's why DBS is our topic. As for the other 2 banks, UOB, UOB's, the worry for UOB is that their fee income is, their customers are a bit more prudent. So fee income growth has not been as high as expected because a lot of their customers, instead of putting it back into investments, into wealth management, right, they're just placing it back into fixed deposits. Right? They're okay to earn that 1% odd, right, instead of trying to get a I guess higher risk, right, in investments. So that's what's holding them back in terms of fee income. For the rest, it's quite similar. The net interest income is also declining slightly, which is to be expected as net interest margins decline. There's one thing that could save them is that they could continue to cut their funding costs. Their one account or CASA, their UOB one account rates are still the highest amongst the 3 banks, even though they cut it about 3 times already, right? So they could continue to cut that in order to improve their funding costs. That's one way that we see them trying to improve margins. So lastly, for OCBC wise, they are still trying to grow their OCBC one group, but I guess it's still it will take time, right? Their dividend policy is also the most flexible, right? It's fully floating, so a lot of their it really fully dependent on how their earnings do, right? In terms of their net interest margins and net interest income, it's similar to the UOB, right? They are also able to cut some more rates, and fee income growth has been slightly better. It's in between UOB and DBS, but they're really trying to push it out and try to capture a lot of that. I guess that the China inflows, right? They are coming into Singapore, so that's what they're trying to do. Greater China inflows. Yeah, so that's all for the 3 of the banks. We have accumulate call on DBS and neutral for both OCBC and UOB. Yeah, I hope that answers all the questions. Yeah, okay, so I think that's all. We have answered almost everything. Thanks again for joining us and taking up some of your lunchtime as well. And we hope to see you in the following week, in next week. Yeah, thanks everyone.